Good morning and welcome to today's webinar. I'm Brandon Okita, Vice President of FIA Insurance Services and your IIAB Cal Vice President. Today's attendees with a California insurance license can receive 1 CE credit for this webinar. There will be poll questions that will appear throughout the webinar, and you must answer all of the poll questions to receive the CE credit. We are recording today's webinar and have muted your microphones to eliminate any background noises. As a note, for those watching this as a recording, CE is only available for those attending the live webinar. The recorded version is not eligible for CE per California regulations. For those watching this live, you can ask questions throughout the session by clicking on the questions icon in the toolbar located at the top right-hand corner of your screen. A copy of today's presentation can also be found by clicking on the handouts icon located in the toolbar. We're very excited today to have Carey Wallace with us today to discuss what should a producer be paid? It depends. Carey is the founder of AgencyFocus, a consulting firm focused on providing valuation, perpetuation, financial, and planning services to independent insurance agents across the country. She is also the co-host of the Insurance Refocus podcast and a frequent industry speaker. IIAB Cal members now have a special access to Carey's services and firm, including a free 30-minute consultation in addition to free members-only webinars such as this. She may be contacted by email at carey@agency-focus.com or online at agency-focus.com. With that being said, Carey, I'll go ahead and pass this over to you.
Thank you so much, Brandon, and thank you for having me today. This is one of my favorite topics because, as everyone knows, people are our largest asset. They're also the largest expense inside an agency, and getting your compensation strategy right really sets up an agency to be incredibly successful, incredibly profitable, able to make investments in other areas of the agency. So one of the most important decisions as an agency owner is compensation. And making sure that you keep the talent that you want, you recruit the talent that is fantastic, and really set up your team for success. So super excited, one of the favorite topics. So this is, I've been in the industry for about 16 years. And since I can remember, one of the top 1 or 2 challenges that agency owners cite is keeping and attracting and keeping talent is the number 1 recorded challenge that an agency has said. It's that and finding markets and finding new business. So 41% of independent agents said their number 1 challenge in 2024 in the agency universe study was finding and keeping employees. An additional 29% expressed the challenge with retaining experienced producers specifically. So that means that roughly 70% of independent agents said this is the number 1 thing on their minds. The thing I would add to this is, I work with a lot of agencies that are contemplating acquiring other agencies or potentially selling. And when I look back over the last 2 years of the reasons people said now might be the time I'm ready to sell, was they lost key talent and they didn't believe that they could recover from that key talent. And that was, if you will, the proverbial straw that broke the camel's back. But talent is critically important. So making sure that we have a comp structure that reflects the culture of the agency and really thinks about how to set this up for success is crazy important. So rather just dive into what do you pay for new and what do you pay for renewal, I'm actually going to start with what is the compensation philosophy of your agency and how do you think about your team, think about the way in which you serve your clients, and you should really be able to define this for yourself. So we got this actually from a Forbes magazine that said to attract new talent, there's actually 10 things that are important to new talent today. And it's really interesting to me that money isn't everything. Not only is money not everything, it actually didn't show up on the ranking in this survey, which was targeted at millennials. It didn't show up on this survey until number 7. So number 1, what was most important to them was they had a place to have an opportunity to learn and grow. They wanted a culture and a quality manager that believed in them and gave them a pathway. They wanted to be interested in their work and feel like they're making a difference. Like all these things are the value of the work that they do, the people around them, and the opportunity around them. They wanted to make sure that the place that they worked embraced technology to help them be successful in their work. They wanted opportunity for advancement. And then they said, my overall compensation is important. They then followed that up to say, I want to be able to be creative. I want it to be fun, and I want to have an informal work environment. So 64% of millennials say they would not take a job if the company did not practice some kind of corporate responsibility. And 88% of millennials said that if the job is more fulfilling where employers provide opportunities for them to make a positive impact. So as I think about this, and I think about this challenge that we have with finding staff, retaining staff, the amount of people that we know that are going to leave the insurance industry because they are at retirement age or approaching retirement age, and the shift in talent that we're going to have, it's so interesting to me. I think that being in an insurance agency is one of the best places where you can feel like you make a difference. I feel like there's opportunity to be so involved in your community. There's a path for those that create a pathway to ownership for their team. It's an incredible opportunity, but it's like the best kept secret. And sadly, there's this impression that insurance doesn't create that, which is nuts. I love this industry. I love the people that I get to meet. I love some agencies that are on the cutting edge of embracing technology. And I can tell you, ride in an Uber with an independent insurance agency owner and see the vast knowledge that they have about, what that Uber driver's other job might be because they've written that kind of company, or they understand the risks inside the place that they work in addition to Ubering. It's mind-boggling to me, the vast amount of information that you get to learn about companies. It just, think about that. And I think we're too quiet about what we have to offer as an industry to people that are coming in. I wish that we did a better job of promoting that. So while this webinar itself is focused on compensation, don't lose sight of the things that you have to offer that really could attract some great talent. Just so you all know, we are going to put 3 poll questions throughout this presentation. This might be the good time to do one as I talk about the purpose of a compensation philosophy. And sometimes you have to think about, what is my purpose? When I set the compensation for an agency, I want to attract the people to join the organization. I want to motivate the people to perform at their best. I want to retain the people that are already here. And I want to make sure that I absolutely want to reward high performing employees and set a clear definition about how the organization plans to reward competitively, and how what they're doing connects to what they can earn, and how it depends on the business conditions and competitions and their ability to pay. So it really isn't just what's the comp, it's really what culture am I trying to create and what does that look like. Compensation philosophy also has a component to it, is what do you want that to be inside your agency? Do you want to be an organization that is the top payer in your industry? You want to lead the market, i.e. position, for 25% of, you're in the top 25% of compensation that someone in your industry can expect, and everybody else is below that. Most times when someone wants to lead the market, they also expect a very high level of commitment and a very high level of workload. If you think about it in an accounting firm, the top 5 accounting firms probably lead the market in compensation, but the hours that are required and the commitment that's required for that kind of compensation level is different than someone who might lag the market. They might not be the most heavy competitor in compensation, but they have the most work-life balance. They can offer flexibility. They can offer, remote work or co-sharing an office or things like that. So if 70% of other people compensate better, but you have great benefits, childcare on site, things like that, you might lag the market from a compensation pers- perspective, but then promote the other benefits that you have. You also might not have, you most likely will not have people that expect others around them to work 80-hour weeks or 60-hour weeks even. There might be this culture of, we want to be present at home for our families, and we don't want to have to work ourselves, round the clock. And then there's someone who might match the market. So that is, I want to know what the going rate is. I want to be competitive. I don't want to outperform the market. I don't want to underperform in the market. I want to make sure that I'm about in the middle, where other people that are paying for the same kind of position, I'm probably right dead center. And I can then offer those things that motivate other people, other besides compensation, and be able to have a well-rounded package. So you've got to ask yourself, what kind of team am I leading? Am I leading drivers that want to earn the most, want to work the hardest, want to be, the fastest growing agency? Am I more of a hunter? That would be leading the market. Am I going to have a team full of maybe farmers that want to react to the leads, want to have a more passive approach? That might be someone who's going to match the market or potentially lag the market, looking for that work-life balance. And you have to say, what is my team today? What do they look for? What do they value? What does that happen? Because if you set a comp plan to get someone that's going to be super aggressive, and you really bring that into a culture that isn't as aggressive, it actually can create discord on your team. And the other being true, if you set a comp plan where you get someone who maybe isn't as aggressive and wants work-life balance, and you set their comp and set the expectation that that's okay, but you put them around a whole bunch of high performers that are trying to drive really hard, they're going to resent that person that doesn't have the same drive. So make sure you're true about, what is my current situation and what am I trying to create? And does my comp plan actually match what that looks like? Some other things to consider is, what is your company's financial position? What's the size of the organization? What are the business objectives? Are we trying to grow and acquire? Are we trying to, what is the culture overall? And then we can go to, what is the salary standards and benchmarks inside the industry? And what is the difficulty that you have in your area to find great talent? If you're in a rural area and you are the best employer that someone has, that's going to be different than someone who's in an urban area where you're competing with far things way outside of insurance, but other opportunities to earn a living. You really have to take those things into consideration as you're setting your compensation structure. So now that we're thinking about our philosophy, we're thinking about what the culture is inside the agency, let's talk about, what does compensation actually look like? It is, obviously, the compensation includes a base pay, bonus opportunity. For a producer, it could be a validation schedule in order to get to on a commission only structure. And then what are those projections and changes that are going to happen as you move through that validation schedule? You should have a role and compensation overview that includes your learning opportunities. What does onboarding look like? What does that career development and training look like? What's the performance feedback loop that a employee should expect to have? Is there any succession planning to move from one role to another or into ownership? What are the benefits that you offer? I get asked this question all the time when we're valuing agencies. If I don't offer benefits, does that put me at a disadvantage? It does, because if you're competing with another employer that has the same comp structure and benefits versus you, they might actually take that, because that person has to then use their resources in order to pay for those benefits. That's one. The second is if you get acquired by an agency that offers benefits, they are going to have to put your people on their benefits plan, which means they're going to add back that expense to buying your agency and therefore take your profitability down. While you might have high profitability because that's not one of the line items on your P&L, they're going to have to add it back because they can't have part of their team having benefits and part of their team's not. So it will be um, it'll be added to the expense and reduce your profitability and therefore reduce the price of your agency, respectively. And then so it's the comp, the learning opportunities, the benefits that you offer, and then what is this work environment? Is there technology to help me? What is the culture? Is it an open culture? Is it a top-down culture? Is it a collaborative place? Are there clarity and expectations? And what is that work-life balance? What does it feel like when you're working in this organization? Those are all the things that you should be able to put out there. And as you're recruiting and attracting talent, make sure that you are not quiet about the things that you are super proud of inside your agency and what those cultures are, because it's not just the money. Remember, number 7 was the money aspect of it. All those other things, those learning opportunities, making a difference, who the people they're working with, are their managers going to be clear and give them, clear guidance, and are they fun people to be around? Like, you should be able to think about that and be able to demonstrate that. Now, you're going to get to the place where I'm really good at this, which is the financial aspect. All of those things up until now are philosophy and culture. But from a financial standpoint, for an agency that is established, I'm not talking about a startup agency, I'm talking about an established agency that's been in business, let's say, for at least 10 years and has gotten to a certain revenue stream or revenue level. Typically, your payroll and benefits makes up anywhere from 47.5% to somewhere around 56% of your total revenue. If you go beyond those areas, you could be a small agency that's learning to scale and grow, and you have to make investments in people until you get to that revenue level. That's a common area that is going beyond these percentages. But for an established agency, if you're going beyond that, what you're doing is setting up the agency to not be able to invest in other areas. Your comp structure is probably not commensurate or in line with what the industry benchmarks are, and it could create an environment where, again, upon the exit or the sale of the agency, if your comp structure is vastly different than what the industry standards are, it could actually create an obstacle for your people to stay with the agency beyond that sale. And again, if your people won't stay with the agency beyond the sale, your expected retention rate could go down, which could then create risk inside your agency and decrease the value of your agency. So remember, one of the biggest decisions you make as an agency owner is setting this comp plan, and knowing what the benchmarks are, what the expectations are, helps you in the moment attract and keep great talent, but it also helps with longevity for people to stay with the agency if it's aligned with what other agencies are paying and other structures are. When it deviates and in that sale it has to be renegotiated, that creates uncertainty in an already uncertain time that could create risk and devalue your agency. Not all the time, but I'm just saying it is a consideration. And it makes sense. If I've been working for 15 years in an agency and I have a comp structure that works great for my family, and that agency owner decides to sell, and their buyer is going to put me on a completely different structure that is fine in the rest of the industry, but it's not something I'm used to, and it ends up that I'm going to make, I'll net less than for the same body of work. I might make less money in the short term. That is definitely not going to be a great retention tool for me in an already uncertain time. So this is a good rule of thumb from a top-down standpoint, somewhere between 45 and 60, 58% of your revenue should be going towards compensation. In order to maintain profitability, that's from the overall. Then to support the operations, overall payroll really shouldn't exceed that 48%, not considering your benefits. And the principal typically takes up 18% of that. These percentages are pretty hard because remember, you could be lots of different sizes of agencies. You could be a personal lines heavy agency, a split 50-50 personal lines, commercial lines. You could be a service oriented agency, a very high sales oriented agency. This is an average agency that's about 1.5 million in revenue. The split typically looks like the principal or owners make up 18% of the overall payroll allocation. Producers make up about 44%. The CSRs make up about 25%, and the admin roles make up about 13%. This can vary widely. But again, if you're just doing a gut check of your agency, that's a good thing to at least pay attention to. And if you're outside the benchmarks, ask yourself why. Well, we don't have producers. We have account managers, and they just respond to the leads that come in. There's no one actually out there hunting. That will look very, very different than what I'm telling you. If your sales and service roles are blended, it's going to look different. It also will make it difficult for your agency to scale beyond a certain level if everybody's doing everything. So again, take this with a grain of salt, but use it as a guide. Other factors to consider are payroll is just one way. The employees that you have in your agency is one way to get the body of work done. Some agencies use a strategy where they outsource certain functions. They might use service centers. Lots of agencies today are utilizing virtual assistants or virtual employees that are employed by a company, and you pay for them to do parts of the service work or part of the process of selling and renewing clients. You might have 1099 employees that don't show up on your W-2. And then you could also use some consultants. Outsourced services might be that you have your accounting function done by a company completely outside. Then your admin should be less. So again, look at the whole picture of the agency. If you're outsourcing and you're using service centers, you also outsourced your accounting, and you have some virtual assistants that show up in the 1099 line, your total payroll as a percentage of revenue should be far less than an agency that is doing none of those things. So remember, you have to think about all the other expenses and the way that you're accomplishing the job and how your percentage should look based on your strategy inside your agency. So let's get to the producers, because that's what this is about. And how should we compensate producers? This is one of my favorite things. So I ran a data analytics company for a period of time, and we executed a salary survey across 22 states. And that salary survey was meant to say, what is the standard for the core functions inside an agency? We wanted to know, what does the owners make? What is the administrative roles? Put those two in the same category. So the owners and admin roles were together. Then we wanted to know, what are the key service compensation structures and what are the key sales compensation structures? And what we found is, when we said, what is a CSR, what is a producer, and what is an owner/admin, we got a lot of different answers about roles inside the agency, and it was not as clean as what we thought it was. In fact, these are the different titles that we get on a regular basis when we're valuing agencies and we ask for their staff listing. When we're talking about all the different roles inside the agency, they might be called producers, account managers, client service representative, inside sales, processor, marketing specialist, renewal specialist, account executive, sales specialist. The list goes on. And sometimes it's unclear if it's truly a sales function, a pure sales function, or a pure service function. Oftentimes it's a blended role, which makes the comp structure for that particular role challenging. So for this purposes, when I'm talking about a producer, I'm talking about someone whose job is to bring in new business for the agency. That's their core responsibility, is to bring in new business. And to some extent maintain the counts that they have there, but their main job is to bring in new business, hunt, and get new business. So when we did this survey, compensation survey, we looked at all the different comp structures for producers, people that were classified in this producer category. And there were producers that were paid with a base pay only, they got a salary. There were people that were paid as a producer that were commission only. And then there were people that in this category that were labeled as producers that got some form of a base and some form of condition or commission as their overall compensation. And so it's funny, we took those agencies and also asked them, how fast are you growing? What is your revenue size? And we categorized them into flat or steady growth, which was anywhere from 0% growth up to 3% growth. Then we had a category from 3 to 7% growth, which was I think that was all my flat or steady growth. Fastest growing were multiple double digits, and heavy growth was over 20% growth. So we then looked at what is the comp structure for the producers that are identified in each of these categories of agencies. So for the heavy growth, you can see that the producers that they had, 82% of the producers that were in a heavy growth performing agency were paid commission only. For those that were the fastest growing, meaning they were double digit growth, they had some 23, it was almost like a bell curve. They had some that were paid base commission or base salary only, 23%. They had 50% of their producers that were on a commission only structure, and another 27 that was a blend of base plus commission, which to me probably means they had some unvalidated producers. They had some 50% of their producers were validated, and some, maybe they were some blended roles. For a flat or steady growth agency, 60% of those producers were on base only, and only 11% were on commission only. That probably tells me that in those flat or steady growth agencies, they really weren't true producers. They were people that were actually had sales and service responsibility, were being paid as more like an account manager, but they called them producers. So my point is, performance follows compensation oftentimes. If you're paying someone to incent them to write new business so they get a higher commission based on what they write, and also a commission on the book that they build, they are going to be focused on doing only those two things. If they have a base pay and they have multiple responsibilities, then they are going to not be as focused on generating new business. So performance follows comp structures without question. It's just kind of a cool, experiment that we looked at in order to look at exactly what impact your comp structure has on your agency. I'm going to spend a little time on this slide so we can go ahead and do our second poll question at this point, give you a couple minutes to answer this before we talk about what are the commission structures and what are those benchmarks that make sense inside the industry. All right. Everybody had a chance to do that poll question? I think so. Looks like we've got, just give it a couple minutes. We only have 86% that voted, and I want to make sure if you want this CE, you get your votes in. Okay, so this is talking about if we have commission structures for a producer, what is the industry average for producers that are commercial based, producers that are personal lines based, for new and renewal. So for here, when you see the building, that is the commercial based renewal or new business commission. The range in this study was anywhere from 52% new business all the way down to 39%, with the most common being 45% new as the new business commission for a commercial lines producer. The renewal commission was the 42 to 29. So you can see that down below. So common structure for a commercial lines producer is 45 new, 30 renewal. For a personal lines, that range is anywhere from 42 to 38 new and 30 to 22 in renewal. So a common structure there is 40 new, 30 renewal, or 40 new, 25 renewal. The minimum threshold for a personal lines agency versus a commercial lines agency varies by the size of the agency, where you're located. But what I mean by minimum threshold is to be paid renewal commission. Oftentimes, large agencies or well-established agencies will implement, we're going to pay you new for what you write. We're going to pay you renewal only on the percentage of your book that it is above the minimum threshold. Anything that is below the minimum threshold will be handled by a small business unit or your service people, and allow that producer to continue to focus on generating business, not keeping the book. And it's meant to incent really focusing their effort where they need to. If you need to be involved in the renewal process of an important client, that's great, but typically takes the 80-20 rule. Wherever 80% of the revenue is coming from, or the 80% of the accounts that are complex, we want to make sure you get paid renewal on that and stay connected to it. And therefore, anything below that gets moved to your service or account manager to take care of that kind of work. The other thing I will tell you about, not just money wise, but when you adopt a strategy like this, it allows the agency to scale and grow, but it also makes sure that there are multiple people involved in the relationship of a customer, rather than just having one producer be the person who touches these accounts. And from a transferability standpoint, that's fantastic to have multiple people be able to demonstrate their knowledge and care for your customer, especially when, if that transition of ownership is going to happen, or there's any kind of transition on your team. Having multiple people involved is really, really important. So this is a very common types of compensation structures. I've seen 50 new, 50 renewal. I've seen things all over the board. But if you're asking me what the common is and what the benchmark is, depending on the size of your agency, it's somewhere in this range. Let's look at this. So we live in a world where we have all kinds of input of information, including Facebook. And this actually came from a Facebook post of an insurance group where someone went to the Facebook group. It's a closed group just for independent insurance agencies. And they basically said, I don't know what to pay my people. So they posted, would you be willing to share the compensation you pay for a producer in-house, ? Or outside sales only? ? Thank you in advance. I'm not even sure I 100% understand the question, but I think what they're saying is, what's my comp for a producer if they're an in-house producer? So already we're not sure what we mean by producer. Could that be an account manager? Is that a service person? Like, what is that? And then, or outside sales only. So one of the responses was, does 80% new business, 35% renewal commission split sound fair for a 100% commission, no salary insurance producer? What do you think? 42 people commented on that. And then commission only producers, what's your commission split for new business and renewals? We get 70% on new business and renewals. The agency gets 30%. In both of these cases, if I ran a typical agency and put together what their payroll costs are, if this is truly there, and they have producers on all of their books, their profitability would look nothing like what agencies that are getting high multiples for. 70% renew and 30% renewal sounds to me like a 1099 arrangement, or potentially a producer owned book, something like that, where they provide all the service on the book as well. 80% new business, 35% renewal. These are not numbers. So my point is, please don't go online and ask other agencies what they're paying. For all we know, this could be, captive agencies. It could be a very unique situation. If you're looking for industry benchmarks, that 45-30 and 40-30 or 40-25 structure is what's most common in our industry. And having a compensation structure that's commensurate with the industry benchmarks is going to set you up to have comp structures that are transferable if and when you need to transfer. It's also competitive, and and make sure what these people are also doing is, by paying such a high new percentage, they are not going from a small salary that goes away over time as the producer validates. They're trying to make up for it, and I'll pay you more upfront as you write new business. The problem with the structure, though, it's really hard to back away from that 80% new once that agent has built up their book of business. So I'm going to suggest a structure that makes a lot more sense and does not put you into a comp structure that's not transferable and will not jeopardize the overall profitability of the agency or the ability for the agency to invest in technology and other things that it might need. Infrastructure, all kinds of service people, all kinds of things. So please, 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 whatever you can do. The internet's not always correct. You should probably take that with a grain of salt. What I didn't show you is this question probably had about 150 responses that went all the way from we pay them a flat base pay to we pay them 40-30 to 80%. I mean, it was all over the place. You can see there were 42 comments just on one of the responses. So let's talk about really setting up a producer compensation structure that's built to grow with you. And how do you get to a comp structure that makes sense for a producer, that you can set those attainable goals? You can be a manager that helps them, has clear expectations, and sets them up for success. This is an example of a planning out what would success look like for a producer, what kind of activity would need to be happening, what kind of conversion rate would need to occur in order to meet the goals that will help you earn the amount that you want and be able over time to predict what a producer will make. This is really important to have some key bits of information to create a plan, because remember, we said part of having a strong compensation structure is having a clearly defined goals that can be measured. Accountability is really easy, and they see a pathway to success. So for this, if we wanted our new producer to generate new business goals of $30,000 in revenue, we'd need to know, what is the average size account that you write? How many accounts that size would you need to be able to make up that account in order to hit that new business goal? We know those two things. So then we can say, if you have a CRM that tracks your sales process, you can look at your own data and then back into how many weekly contacts would a producer need to make to end up with 60 new accounts at the average size of 500 in revenue. And in this situation, they were able to say that their contacts to appointments was a 33% conversion. So they needed 15 weekly contacts in order to get to 5 weekly appointments. That would give them 20 appointments during the month. Their annual appointments would be 240. Their proposal per appointment ratio is they were able, based on their track record in their agency Zoom, they could see that 50% of their appointments resulted in them sending a proposal. That would mean for the year, they'd have 120 proposals that are out. And if they have a close ratio of 50% on their proposals, they would end up with 60 new accounts and hit their new business goal. If you want to see a planning tool like this, it's super simple. You can scan the code, download it. And the key is they knew their conversion rate from contacts to appointments and appointments to proposal and proposals to closing. If you don't know that, those are some data points that are predictive metrics that helps you determine is someone on track. If in the absence of this, the owner would only have, did you generate the revenue at the end of the month, not did you have the activity to support it. And the other thing is, if you are tracking all of these things and you see that they are able to generate the contacts, but they're not converting, you know where to go in and train and help this person be successful. So having the leading indicators allows you to know when to convene and set them up for success versus someone who only has the lagging indicators, which is the revenue. This thing can then be translated to say, I know if this person is able to create this new business of 30,000 in year one, which is in the middle of the screen right here. I don't know if I can do it. Hang on. This is the middle of the screen. I know that I can pay them a base pay of 35,000. They would make 45% on their new business, which would be 13,500. They are set up their first year to make 48,500. If they do a retention rate of 95% of their book of business, next year they write 40,000. We give them the metrics. In year two, we think they're going to make more than what they were going to. We know that they're going to make 18,000 in new business. Their renewal is now going to be 8,500. They have a declining base pay of 25K. They're set up for 51,000 the next year. Same thing. The next year, we think that they're going to write 22,500 in new business, 95% renewal on the accumulated book, makes another 19,000 with a 15,000 base. If they are successful, they'll make 57,000 that year. And by year four, there is no base pay. Their book is now supporting them at that 57,000. This is an example. I know that people expect to make different things in different parts of the world, but you get my point that you now can say, how many new accounts does it take to hit my goal? From an owner's standpoint, I know that I need $35,000 in base pay for year one, 25,000 in year two, 15 in year three. I know what my outlay and my investment is. I also can manage the leading indicators to know if this producer is on track to validate. And now I have a much better way of managing that, not just waiting to see, did they generate the revenue? It's a far more predictable structure to put in place and be able to think about how we can set people up for success to validate as producers. Again, this could be on track to make 100,000 the first year. You would just work with the size of the account, where you're located, how many accounts that it's needed, and what that base pay would need to be. What I love about this is, as an agency owner, you know exactly what you need to do. As a producer, you know exactly what you need to do in order to be successful or crush the goal. And you can say, and do I feel confident, given the infrastructure, the technology, the lead sources, whatever, the support, that I can generate 60 leads or 60 accounts a year? And if I don't take the job. But when it's broken down that way, it makes it much clearer for someone to be able to predict whether or not they're able to do that. So before we move into this, because there's plenty of people that have compensation structures today that maybe don't have minimum limits, or they have a different comp structure, or they're at that 80-30 structure. We're going to jump into what do we do if we have that and we need to move people from one compensation structure to another. Before we do that, we're going to put our third poll question up for you guys and give you a chance to answer that question. All right, you guys are getting it done. Fantastic. All right, we got 86%. So that looks like the number of people that want to get CE. So I'm going to move on. So let's say we have a producer that has 400 accounts and their gross commission is $300,000 a year. But you can see that 80 of those accounts are in their smallest accounts and only make up 6,000 in commission. The next 240 accounts make up 42K, et cetera, et cetera. So you can see that 49% of the commission actually comes from 20 accounts. You can then predict, if we stratified this and we put a minimum threshold in place for this agency, we can reduce their accounts to 220 and their gross and create capacity for them to write more business. Therefore, they actually could be on track to make more if they focus on larger accounts versus smaller accounts. So this is what it looks like. If you're able to then really mine their book and say, how many accounts fall in each category? How many are you actually involved in? And how do we create time for you to focus on the accounts that give you the most bang for your buck and are most profitable to write? We could then predict what would happen and make them much more successful going forward. So if they were able to write an average size account, go from 750 in revenue to 2100 in revenue, that would only require them to write 220 accounts versus the 400 accounts and be able to only change the commission structure of about 15K in commissions. The trick is you can't go from this to one in one fell swoop. You typically do it in a stair step to say, we're going to move your minimum threshold up a step to take off some of those larger accounts that no longer get paid renewals. They become house accounts. That capacity allows you to change your strategy in selling. The next year, we move that threshold up again, where it's a stair step approach from one comp structure to another. If an agency has a really high new business commission rate and a really low renewal rate, you can actually adjust the renewal rate for those for those clients that are above the threshold to then even that out, still incent them to write new business, but again, stair step from one comp structure to another is the way you do that. The hardest comp structure to stair step is when someone is paying 50 new, 50 renewal, or 60 new, 60 renewal, because there's really no movement in those. The producer just feels like you're taking money away. That is when I would suggest some other kind of incentive program to think about how can we retain this person, put them into a comp structure that makes sense and that is commensurate with the industry, and hopefully set the agency up to have the right kind of profitability. Because if you're paying a producer 50 new, 50 renewal, and their book size gets to a point where there's no possible way they can manage that book, and you've had to hire 2 or 3 account managers to manage that account, you're now paying 2 people for the body of work, and it hurts the profitability of the agency. So someone asked me, these minimums, are they per policy or per account? Actually, they're typically per account because there's no way for one, it'd be really, really labor intensive to only pay based on a policy. And typically accounts that have multiple policies, you're going to be involved as a producer. So it has to make sense inside your agency. So what I'm talking about is per account, what that minimum threshold is. You could have an account that has 6 policies that hits over the threshold. It's probably complicated enough that the producer needs to be involved. Therefore, it would meet that need. But for many people that are stratifying their account, they go account by account and figure that out and figure out where that line is. In some large accounts, they haven't been involved in a long time. I think the whole point is find the right fit for inside your agency where this makes sense, but typically it's by account, not by individual policy. Great question though. So before we talk about the incentive programs, in a producer arrangement, there is a tendency to have a couple different kinds of structures. There are people out there that have 1099 producers. We're going to talk about that. I am not a lawyer, but I can tell you a 1099 engagement, typically as a buyer, you would look at that and question, does that 1099 producer have ownership in the book? If they have ownership in the book, that is an asterisk on that purchase, because if they have a large enough book, the owner doesn't own it, the producer owns it, I have 2 options as a buyer. I'm now negotiating with 2 people, or I'm only negotiating with the owner and I'm only buying what the owner owns. If it's gray at all, I'm going to assume that question mark creates uncertainty or risk, and I'm going to discount that part because I don't know if that producer is going to try and take that book. It gets worse if there's no contract in place. If it's just silent, there's a handshake, that's a he said, she said situation. So have contracts in place that make it clear who owns the book of business. Have the, and there's a lot in the news right now about non-competes not being enforceable. I'm talking about a contract that explicitly states non-solicit terms and non-piracy. You can't contact our customers and you can't contact our employees to take them with you. If there's a 1099 arrangement, which I do not recommend, only because unless it's truly a 1099 arrangement, and that means that producer can sell for multiple agencies, that they're placing some business here, but they can maybe, work with 10 agencies to write life policies in 10 different, that's what a 1099 is. It's like the person that remodels my bathroom can also remodel your bathroom and 5 other people's bathrooms. I don't direct their time. I don't direct their schedule. All I do is contract with them and they fit me into their schedule when they want. If that's the arrangement and it's really true 1099, that's fine. Just have a contract in place that says who owns that book of business. If you want, and I'm an advocate for creating incentive programs to keep key people with your agency, I highly recommend figuring out a way to have a minority ownership in the agency, not in the book. Because the moment it's book ownership, it gets gray. Let's say I give them ownership, 20% of their book they own. If it's not a really well contract, I won't know which 20% of the accounts they own. So when I go to value the agency, which 20% of that book should I exclude? And what does that do to the carrier concentration or the contingency expectations of that agency when I exclude those accounts? If it's not clear, it becomes uncertain, it slows down everything. If you calculate that producer's ownership as a minority ownership in the overall agency, the book stays with the agency, and at the time of sale, they get a minor percentage of the sale of the whole agency, not just their book. The last piece is, if you are going to do percentage of ownership in an agency as an incentive for, let's say, put a performance clause in there that says your book or your performance needs to grow at the same rate as the agency. Because if I give someone 2% ownership in the agency and their book doesn't grow for the last 10 years, but the agency does, now what I've given up is far greater than what they've contributed. So there has to be a really well-written contract in order to do these incentive programs. There's 2 other ways to do incentive programs that are ownership. One is phantom stock or deferred compensation. I believe that one of the most underutilized retention tools is doing one of these incentive programs to keep your key people inside the agency, aligned with you and growing the agency rather than leaving and wanting to build a book and then leave and build it on their own. So I'm going to briefly go across these, but I have an entire presentation on this topic alone. This is the 1099 definition. So there's 3 ways to say whether or not you're a 1099 eligible, which again, I'm not the IRS and I'm not the Department of Labor, but I have seen some of my clients go through an audit and therefore owe back payroll taxes because they had people classified as 1099 employees that were truly actually employees. So do we have behavioral control, financial control, or relationship that the workers are there for benefits? And can they provide similar services to other businesses? With a W-2 employee, we have the right to direct their work being performed. You give the instructions, provide the tools, training, equipment to complete the work. You also provide the carrier appointments for them to write the business. You set their hours and their schedules. In a 1099 contractor, they use their own methods and tools for completing the work. They may work for a specific project or period. They do their own schedule and they can do the same service for other businesses. If that's not true, they're really not a 1099. The thing that's really interesting is that carrier contract and accessing it through you makes it a little bit like you have standards for which you want them to place business with these carriers, which makes it hard for them to fall in that 1099 category. Okay, so if we're going to put an incentive program in place, you have to think about what's the purpose, what are we trying to incentivize, who on the team is eligible for the current and future positions, what percentage of the company will be reserved for the plan, and what will participants receive of the base value or by growth over the base value. And then potential payout, frequency of grants, how it vests. Typically, you say this that you're eligible, let's say at 5 years, at 10 years, you're 25% vested, at 15 years, you might be 50% vested, and if you stay for 15 years, you're 75% vested. You hit the 20 mark, you get the full payout. That kind of structure is what keeps people with your agency, because it becomes hard to leave and give up this incentive pay or some kind of profit sharing or whatever that incentive is at the end. So very easily you can do incentive compensation, you can do stock, you can do phantom stock, compensation incentive, or book ownership. I've already told you why book ownership has some pros and cons, which means it could actually weaken the value of your agency if that's what you offer. A stock. Not everybody wants ownership. Not everybody wants the tax liability with being a stock owner. Not everybody wants a K1. So you have to know what somebody wants in order to figure out which one of these incentives makes sense. Phantom stock is a structure where it behaves like stock and it could have a component of annual profit sharing, and it could have a component of what happens when the agency owner sells. Incentive compensation can have a component of profit, can have a component of when it sells, or could be a dollar amount, which is most likely. So there's lots of different ways to think about this, but you got to go back to what's important, what's most important, and what are you trying to accomplish with this, and what makes sense for the person that's there. But oftentimes, this is the strategy that's used to get from one comp structure that may be out of line into another by then offering some kind of incentive to keep that person and really demonstrate how important they are to your agency. So lots and lots to think about with compensation. It is your single largest controllable expense for your most valuable agent or most valuable asset, which is your people. Getting it right is super, super important. I would love to answer any questions that you have. If you want to talk about your comp structure specifically, you can reach out to me and my team. We have about 7 people on the team. As they said, you have 30 minutes free consulting to talk about anything. I also want you to know that we host a podcast where we talk about agencies and lots of different topics, but one of them is setting up teams, putting comp structures in place, thinking about things when you want to exit, how you want to bring partners on. Like we focus on the financial aspect of running an agency and what some innovative agents are doing. So if you want to tune into the podcast, you can. We'd love that. I'd get to do it with my daughter, which is kind of cool. But I'm happy to answer any questions that you might have. All right, Brandon, I think I'm handing it off to you.
Okay, thank you, Carey. And as Carey mentioned, her podcast is called Insurance Refocused for those of you that want to join and listen in. Again, Carey, I want to thank you again for spending this time with us today. And again, another reminder to our members that you have access to Carey's service and firm, which includes a free 30-minute consultation in addition to all of these free members-only webinars. Again, if you qualify for the 1-hour CE credit, you will receive an email with your certificate of completion once we complete the attendee filing with the California Department of Insurance. And with that, that concludes our webinar, and I thank you all for participating. And thank you again, Carey.
Yep.
Bye-bye.